Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, my name is Ravi Singh. We've just released a monthly India market outlook titled Staying Safe. In today's podcast, we will discuss a key question on the implication of the RBI's decision to pause the rate hikes and our asset class views. Well, in the latest monetary policy, the RBI kept its policy repo rate unchanged and maintained its policy stance of withdrawal of accommodation. Now, after raising policy rates by a cumulative 250 basis points in fiscal year 2023, the RBI appears to be signaling the end of the rate hike cycle. With rates likely to peak, does it make sense to be constructive on equities as has been the experience in past cycles? While generally an end to the rate hiking cycle could be considered positive for equities, as a subsequent decline in interest rates theoretically leads to higher stock valuations. It is also important to note that the positive impact to valuation is influenced by several other factors such as corporate earnings performance, stage of the economic cycle, and government reforms. In our analysis of the past RBI's rate hike cycle, we found that while equities on an average saw positive returns over the 12 months post the last rate hike, averaging around 11%, however, the variance of outcomes was quite large. For instance, during the 2001 and 2018 cycle, Indian equities fell despite rate cuts. However, in contrast, the 2011 and 2014 cycle, equities delivered positive returns with both these periods accompanied by an improvement in domestic economic growth. On the other hand, bond yields have typically behaved more predictably towards the end of the RBI hiking cycle. Historically, a peak in the 10-year Indian government bond yields have almost always occurred around the last rate hike, before falling by an average of 140 basis points over the next 12 months as slower growth and lower inflation weighs on bond yields. Nevertheless, a lower starting yield in the current cycle compared to the previous cycles could result in modest moderation in bond yields going ahead. In our view, the prospect for Indian equities has improved amid the recent underperformance and moderation in valuation premiums. However, given the uncertain global macroeconomic backdrop, we retain a balanced asset class outlook with a neutral weight on all major asset classes. Bonds continue to offer an attractive income opportunity as we are likely close to the peak in rate hike cycle. Cash yields are at a 4-year high and serve as dry powder for any intermittent opportunity. Gold remains a hedge against inflation and equity market volatility. Now, moving on to our individual asset class views. On bonds, we maintain a neutral stance as attractive absolute and real yields are counterbalanced by lower yield premiums, stretched medium-term fiscal position, and weak government bond and demand-supply balance. The RBI's recent pause in policy rate is a tailwind for bonds. Within bonds, we are overweight short maturity bonds given the lower sensitivity to rising interest rates and attractive carry-on offer. On equities, we continue to maintain a neutral stance. Higher than average valuation premiums, both absolute and relative to peers, is counterbalanced by robust domestic growth and resilient earnings growth expectations. We maintain our overweight on large cap equities given relatively better macro fundamentals and a greater margin of safety in terms of earnings and valuation compared to mid cap and small cap equities. Cash continues to remain a neutral holding, and finally gold remains a neutral holding and a portfolio hedge against elevated inflation and equity market volatility. That's it in this edition of the podcast. Do reach out to your relationship manager for a copy of our India Market Outlook. And thank you as always for listening. If you enjoyed the podcast, please like and subscribe.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered relationship manager or visit www.se.com/in.